This is question number 6 on the assessment test. So this is a question also on capital budgeting and estimating the free cash flows. So this firm is considering a new 3-year expansion project that requires an initial fixed asset investment of $2.97 million. And after that, I just want to check the rounding requirement. Do not round intermediate calculations. Enter your answers in dollars, not in millions of dollars. So I the habit for me to solve any capital budgeting problem is first step is to get all the numbers into the right place in my Excel worksheet. So as I read along the setup, I would like to do that. So first put down the year number. So we know that we have basically a 3-year project, right? It's a 3-year project, and we have the information for the initial investment. And the amount turns out to be $2.97 million. So it's 272 million $970,000. And it's the fixed asset. It's also telling the following sentence says the fixed asset will be depreciated straight line to 0 over its 3-year tax life, after which time it will be worthless. So basically, this worthless here means the book value. It doesn't necessarily mean that the asset will not be sold for any money on the market. Actually, as you'll find out, this sentence also tells us that the fixed asset will be sold at the market value of this much. So basically, this sentence tells us the depreciation, right? Annual depreciation. So the depreciation will be the initial investment divided by 3 because it's a 3-year project. And because I want to extend this formula to other years, so I would like to fix this sale value of the initial investment. So when I drag the sale to all other years, that value won't change. So that's the purpose. So that's and then we are done with the annual depreciation calculation. And the project is estimated to generate $2,170,000 in annual sales. So sales will be $2 million and 170,000, and this will be the same for each year. With cost of $865,000. So the cost is $865,000, and this also is the same across all these years. The project requires an initial investment in net working capital of $390,000. So NWC is $390,000. It doesn't mention anything about subsequent net working capital, but by default, this level of the net working capital will be maintained throughout the years except for the final year. And typically, because by the end of the project, all the net working capital will be liquidated. Hence, the final level of the net working capital will be generally should be 0. So that's the default assumption. If the problem doesn't mention anything about that, it's natural to assume that. And the fixed asset will have a market value of $255,000 at the end of the project. So basically, this is telling us the so-called salvage value. Right? This is the before tax salvage value by the end of the project. It's $255,000. But we need to understand we will need to calculate the tax rate is 35%. The after-tax salvage value. So I think I'm basically done with putting the information from the setup into my worksheet. So the question is asking what is the project's year 0 net cash flow, year 1, year 2, and year 3. So check the rounding requirement again. Do not round to intermediate calculations. That's another benefit of using Excel because it automatically meets this rounding requirement. And the negative answer should be indicated by a minus sign. That is the first. If we find the free cash flow of a given year to be negative, then we should put a negative sign in front of that cash flow. So going back to calculating the after-tax salvage value, and in order to calculate that, we need to understand what is the tax base for salvage value. And this refers to the salvage value, which is basically what the firm gets from by selling the asset on the market. But then, as we said, the firm needs to pay taxes by that. And then the tax base will be the difference between the salvage value, or the before tax salvage value, and the remaining book value of the asset. So that's the tax base basically. And then how do we figure out the remaining book value of the asset? Actually, the question already told us because it's telling us that the initial investment or fixed assets will be depreciated straight line to 0 after 3 years. So that's telling us the remaining book value of the asset is actually 0. So that means the tax base should be simply be the tax should be the salvage value. So that's the same here. And now from the tax base, we can calculate taxes, right? It's simply the tax base multiplied by the tax rate. So now with that calculation, we can calculate after tax salvage value. So this is simply the difference between the salvage value and the taxes the firm needs to pay on that salvage value. So this is the after-tax salvage value. And then the NWC, we also need, in order to calculate the free cash flow, we need to we need not only we don't need the level, right? The level of the NWC. What we need is the incremental NWC, or the change in NWC. And the change at the starting year, because there's no prior year, change is simply the same as the level. But starting from year 1, the change can be calculated as that year's level of NWC minus the previous year's NWC. So we can extend this formula to all other years. So now I have everything which are needed in order to calculate my free cash flow. But if I write down the formula for the free cash flow, we should start from operating cash flow. And then we do 2 adjustments. One is to deduct the change in NWC. And we have done that part of the calculation already. And the second adjustment I need to do is to deduct capital expenditure. So that refers to the investment. And that's the normal case, but in this case, we also need to consider the salvage value, or the after-tax salvage value, because that's also giving the firm the cash flow. So we should also add the after-tax salvage value. So that's basically how we can get the free cash flow. So looking at this formula, we can see that we have already calculated the change in NWC, and capital expenditure is the investment that's also provided, and after-tax salvage value, we also did that calculation. So the only thing missing is this operating cash flow. And then how can we calculate operating cash flow, right? So we just add probably one more row here. So the operating cash flow formula is EBIT, earnings before interest and taxes, right? And then we add back the depreciation, and then we deduct the taxes. So, and then the depreciation is provided, and taxes will be based on this EBIT. So in order to calculate operating cash flow, we need to calculate EBIT. So EBIT basically is sales minus cost and then minus the depreciation. So that's what the EBIT here, how that's calculated. And then we have the EBIT, we have the depreciation. The only thing missing in order to calculate this OCF is the taxes. So now, in general, taxes will be based on EBT, right? Because EBIT is earnings before interest and the taxes. And then we should further deduct interest from EBIT to arrive at EBT, which is also called taxable income. So taxes will be generally based on EBT. But in terms of capital budgeting, we should incorporate the effect of interest or debt on the project value into the discount rate, not into the cash flow. That means in terms of estimating the cash flow, as we are trying to do here, we should ignore any interest expense. So the taxes now will be based on EBIT rather than EBT. So taxes will be EBIT and then multiplied by the tax rate. So now I want to fix this tax rate sale value. So I don't want this to change when I calculate the taxes for the other years. So now I have everything ready in order to calculate this OCF. So OCF is EBIT, and then we add back the depreciation, and then we deduct the taxes. And then we extend this to all other years. So that's the OCF. So now with OCF, I can also calculate the free cash flow. So free cash flow is the OCF. Even though for the starting year 0, OCF is empty, but still I need to put this as the value because later on I want to extend the formula to all the other years. So then minus the change in NWC, and then minus the capital expenditure, which is this initial investment here, and then plus the after-tax salvage value. And then I can extend this formula to all other years, and Excel will automatically calculate the free cash flow for me. So the final part of this work is simply to copy the number back. So just copy the number back. Just double check we have a negative sign. Yes. And for year 1, it's this amount. And for year 2, it's the same amount. But for the terminal year, because of the after-tax salvage value, the cash flow will be different. Now the final part, if the required return is 9%, what is the project NPV? So the Mpv calculation, we could use the Mpv function in Excel. But remember the Mpv function, first argument, if you check the first argument is rate, that basically refers to the discount rate. So it's 9% here. But starting from the second argument, or the value 1, value 2, value 3, and so on and so forth, this refer to the future cash flows starting from year 1. So that suggests the Mpv function in Excel actually only calculates the PV of the future cash flows. It doesn't include the net part of the Mpv. So after we have used the Mpv function to get the PV part of the Mpv, we still need to manually add the initial outlay in order to calculate the Mpv. Why I add instead of subtracting? The reason I add is because we already took care of the sign on the cash flow. So the initial cash outlay in this case, you can see it's a negative number already. So I should add a negative number, which means that I subtract a positive number. So the Mpv function is, as I said, I should start from year one's cash flow and all the way to the last year's cash flow. In this year, the year three's cash flow, and close that. And after that, just manually add the initial cash outlay. And then just because in some prior questions, I formatted the cell to be in percentage format. So that's why you can see that this is shown as in a percentage format, but I just need this to be in, I'm assuming it's keeping two decimal places, but I need to go back and check, do not round intermediate calculations and round to answer two decimal places. And that's exactly what the question is asking. So just copy this number back and now check my work. It's correct.